Focus. Ideate. Innovate. Enable.
Hello and welcome to Investor Camp New Delhi, a city that actually holds a very special place in both our hearts, both Anuj and me. We left almost a decade here to make Mumbai our home, but Anuj, it's always great to be back here in Delhi, isn't it?
Oh yes, this is where it all started, Surbi, right? I mean, Jhandewala, that small office that we had in 2003. Both me and Surbi actually joined in same year, and it's been a phenomenal journey, of course. So we have now moved to swanky offices, even in Delhi as well.
Yes.
But this is where it all started. So it feels special that we have another investor camp in Delhi, an audience which loves its investments, an audience which loves its trading, and I'm looking forward to it, Surbi.
Anuj, speaking of journeys, I mean, that word kind of rings a bell even when you think of the market and the way we've sort of moved higher and the way the euphoria has been, the kind of participation that we're seeing from, domestic funds and perhaps a lot of retail money as well. What do you think of the last couple of weeks that we've seen?
This has been the maturing of Indian market, Surbi, because, in the past bull markets, you'll have one correction, retail will throw in the towel, and the market will correct 30-40%. What has happened this time is that retail has looked at every 1 or 2% correction as a great buying opportunity. I don't know, we have said FI money, it's okay. You don't want to invest, we don't need it. We have enough money locally available, which has really propelled this market. And I think you'll see that as we move forward and as we interact with the audience here in Delhi. People have made a lot of money. Domestic people have made a lot of money, which is something that gives me a lot of heart.
Okay, so then without much further ado, let's straight away go ahead and listen to our first guest of the day, a man you know so well, Ashwini Gujaral, the guru of technicals. Here he is with his tips on how to understand this market.
Now, why is 20-day moving average important? Because, as my friend Anuj says, it is fact. Every day we have people coming on the channel, no, market is expensive, earnings haven't caught up, etc., etc., etc. But the market keeps going up. Now, how do you differentiate opinion from fact? Once you have an objective measure of where prices are going, okay? So that is where technicals are very useful. See, if I had to write a PhD paper, I would listen to all this opinion and try to do a statistical analysis, etc. But here, opinion which is not respecting the direction of the market is useless. So for a lot of you, you want to know where your stock is going, and the simple way of finding out is to have a basic charting software which most brokerages give these days, and look at the direction of the 20-day moving average. If it's pointing to the upside, your stock is going up. If it's pointing to the downside, your stock is going down. End of story. In most cases, stocks which are in good uptrends, if you just keep hanging on to the 20-day moving average, you'll stay in while the trend is strong, and finally the 20-day moving average will take you out. If you have a 200-day moving average, that tells you trend. And the 20 DMA gives you the operational metrics. So the best places to buy is below the 20 DMA. So you can have several, types of buying. If you are above the 20-day moving average, even if it's going up, that's a light buy. Below the 20-day moving average, you should be a medium buyer. And way below the 20 DMA, you should be a heavy buyer. A nice example is Yes Bank. It went very close to its 200-day moving average and close to 1400. I kept on saying it has bottomed out, it's time to accumulate. So it was below its 20, very close to 200. So you need to buy sharp corrections below a rising 20. And that is what you got over the last week to 10 days. There's no value in doing 100 shares while the market is choppy, sideways. And again doing only 100 shares when you are sure, or when it's looking very likely that the train is bolting or the horse is bolting out of the stable. So keep this in mind that you have to make it big when things are moving in your direction. The size of your profits when you are winning minus the size of your losses when you are losing, that determines your net profit. A lot of people learn technical analysis from books, आधा सीखा आधा नहीं सीखा. The difference between technical analyst and trader is the difference of compounder and a doctor. The compounder only knows के किस बीमारी की क्या दवाई है, लेकिन कितनी देनी है, कब तक देनी है, क्या ये कैंसर तो नहीं है, ये सिर्फ डॉक्टर ही जान सकता है. So, don't trust those 2-day courses which happen when the bars are stationary. Trust courses when the bars are moving. Secondly, understand that markets most of the time are random. There are only some periods when the markets are benevolent, and that is where you should maximize. Plus, staying in is very important. One of the reasons I am called every 1 hour is to tell people whether अभी भी अच्छा लग रहा है या नहीं, रखें या बेचें, right? So instead of asking me or trusting my judgment, have an average which is respecting your trend, and till that respects your trend, stay in. Most amount of money is made by staying in. Everything takes practice. Practice one component of the strategy every time. Practice entry first, then practice adding up, then practice riding it. I think if you practice enough, you will possibly start making large amounts of money, because we are getting those kinds of trends these days where stocks are able to move 25, 30, 50%, even 100% if you choose stocks properly. You've been a good audience. Thank you.
Okay, that was Ashwini Gujral, the guru of technicals. But let's do one thing. This is a market about multi-baggers. We'll take a break. When we come back, the master of multi-baggers, Ashish Chugh, will tell you his investment thesis. Welcome back. This is an investor camp from Delhi. Of course, before the break, you heard from Ashwini Gujral. But Ashish Chugh, a well-known name in terms of finding multi-baggers. His last investment went 50 times in last 3 years. How does he find all of these? Let's hear out from him. Ashish, what's the basic process that you go through? I've been told that you only look at bseindia.com. Whatever research you do is just available on that exchange website, and you don't look anywhere else. Is that true? And I mean, what's your overall thesis in terms of identifying these multi-baggers?
This is a kind of thesis where the idea is to invest in 10 stocks. I'm just giving you a hypothetical figure. Now, what will actually happen is, out of these 10 stocks, 3 or 4 may not perform, or they may perform along with the markets. You have to be prepared for, say, 1 or 2 stocks which become absolutely zero. Practically, it has, touch wood, not happened to me. But there could be scenarios where the stock gets delisted from the exchange. But then you have to bank upon the 2 stocks which can potentially be 20, 30, 40 baggers. Now the challenge is that generally what happens is, people buy a GVK at 9 rupees and a Avanti feed at 100 rupees. They end up selling Avanti feed when it goes to 150 rupees. And end up holding GVK power even at 5 rupees. So the thesis is that you have to evaluate what the company is doing, and you have to sometimes ignore the short-term negatives in terms of some event-based negatives which come up in companies, or some quarterly numbers which are maybe below analyst expectations or below say the last quarter. So you have to sometimes ignore those and understand the reason for those negative numbers, so that you get conviction to hold the stock. So that is the basic thesis behind this. So answering your question, Anuj, I am generally looking for, in one line if I have to say, good businesses which are managed by ethical people, and more importantly which are available at reasonable valuations.
Ashish will talk about some themes, and my sense is that you'll be able to make out the kind of stocks that Ashish is referring to. Themes that you're backing right now, Ashish.
Okay, Anuj, I am generally looking out for companies with short-term negatives, as I told you. Now there is one area where the companies have done expansion in the last few years. They have done capex. Now what generally happens is, when you do a capex, say building of plant and machinery everything may take about 1.5 to 2 years. When the plant is ready, you don't start making money from day one. Plant may be operating at 20% capacity, there will be a process problem, there will be some teething problems. That plant may take 1 year to get established. But what happens in the interim is that your depreciation cost goes up. You may have taken some loans for making that plant, so your interest cost goes up. Because of these two things, your profits may come down. Now what happens is, if I take a scenario that the company has not done anything, vis-a-vis they have put a new plant. So in the first scenario, my profits would have been much higher because my depreciation is low, my interest cost is low. But even though I have done an expansion, my profits have become low. So what generally happens is that a lot of people sell the stock because of lower profits. So that is an area which I am looking at very carefully. Lower profits would mean lower valuations, lower stock price. But what will actually happen is, as there is a demand pickup, or when the operations of the company stabilize, there could be a huge jump in sales and a consequent increase in profitability. So that is one area or one sector which I am looking at, because when the profits are low, I am able to buy the stock at bargain prices. So that is what I am looking at.
Ashish, for the first time investors, any do's or don'ts, any major points to remember?
Well, Anuj, I would say that, equity investing is nothing but a mind game. Okay, but the problem with this is that stock price movement messes up your mind. So I think it's a game of mind control and keeping your temperament under control. I think a good thing would be to not to really look at the stock price on a daily basis, but look at what is happening to the company and where is the valuation of the company going. So that is very, very important. And I think that you don't really need to be a MBA from a IIM Ahmedabad or IIT graduate to do well in equity markets. My belief is that a person with average intelligence but the right kind of temperament can outsmart anyone from a very good college background. So one thing to do is to develop an independent thinking. You must listen to everybody, but create your own opinion about which stock to invest and what is good for you.
Some great ideas as always with Ashish Chugh there. Now let's listen in to what Prashant Prabhakaran, President and CEO of Yes Securities, has to say about this market that has soared so high so fast.
We'll talk about first global liquidity coming into India. On most of the parameters, India stands way ahead of competition of. You're talking about growth. It is among the fastest growing countries in the world of. It remains, most of the other emerging markets are struggling with either political issues or growth related issues or debt, which is very high. The last portion is debt. Our combined savings plus corporate debt put together is still at a level which is way lesser than the international levels that other emerging markets are at. Our dependency on commodity in China is fairly low as compared to the other players in the market. Currency has outperformed, and other emerging markets have just begun to stabilize. We haven't even started the journey of structural reforms. We have done a lot of administrative reforms at this point of time. The first big step is GST, and the implementation of that will be a game changer for India. So we are in a sweet spot. We have reached valuations at a particular level thanks to a lot of other factors. But we talk about the effort that we have put in the last 50, 60 years. We have produced 130 crore Indians. So the consumption that we keep on talking about on a regular basis, you have got to understand that as compared to maybe a China also that has grown the fastest in the last decade or so, we are way behind on most of the parameters, be it housing. We are still at a 2006 level that China was at, and they have exploded from there. They are practically 3 times when you compare to the way housing has taken off in China. You talk about clothes and footwear, we are 4 or 5 times lesser than China of most of the parameters with our population, will see an explosion that will happen in the times to come of. As we talked about GST, there are areas that have got covered. We have factored it down into goods and services. You have taxes, the advantage or the final outcome which we'll get to know in the 6 months to 9 month time frame post implementation will be how much of extra money will get collected into the entire bargain, which will be used to develop India by way of infrastructure in the future of. So this is the chart that you will see of Nifty for from 2005 till date. It basically means that Indian valuations tend to revolve in and around the mean. You're talking about a 17 and a half to 18 P ratio in the forward earnings that we are talking about. Whenever it has gone beyond a particular level and it is not justified, it has cracked, but it has moved up equally fast. But it remains within the range. You have to end up looking at the second portion of the story. Will earnings catch up? It definitely will. All the ground blocks that are required to make sure that Indian economy takes off are getting laid off. You have balance sheets which have become, so we'll come down to a portion of balance sheets a little later on. The second portion is comparing it with 10-year G-Sec yields as compared to the returns that are there, the comparable PE that is there. Always inversely proportional, and it will continue to do extremely well in the future also. India is in a good spot. Macros are favorable. There might be short-term triggers which will end up either giving a fillip into the return cycle that is there or a dip, but remain invested, choose companies, track performances of, make sure that you track consistent quarterly returns, quarterly balance sheets of most of these companies. You'll end up getting a trend which is more or less there. You'll find an aberration which might be a buy-in opportunity. You might see a dip which is continuous, which will be an exit opportunity. So you have to track if you are into the direct investment. Otherwise, look at performance of mutual funds and give off money to professionals who end up managing in the space of.
We need to take a quick break on that note, but on the other side, the most interesting part of this interaction, what does Delhi have to say about its investments? We'll get you the audience Q&A.
Welcome back. We are in Delhi for Investor Camp, and tell you something, the best part of Investor Camp is the interaction that we have with the audience.
I thought you were going to say the food in Delhi.
The food in Delhi, this audience actually loves its market and it loves its food. But let's do one thing, let's talk about market. Here's the interaction that we had with the audience.
My name is Pamela Bhardwaj, and I have a question for to the panel regarding the PMS and the mutual fund comparison, if you have your view. How do you recommend a PMS to an individual, or how do you recommend the mutual fund schemes?
PMS, typically the minimum investable surplus that is there for PMS 25 lakhs plus, which basically means that SEBI has already laid down the rules on who will end up managing which set of funds. These are usually investors who like interaction. So PMS typically is broken down into two. You have NDPMS, which is non-discretionary, where you can interact with the fund managers and end up taking in suggestions. You can say no in case you do not want a stock. Or you have a discretionary where the fund manager manages it. You end up getting quarterly results for the PMS funds that are managed by them. And you can end up taking decisions on a regular basis of.
I bought about 500 shares of Inox Wind. And my goal is about 3 to 5 years. Do you think it will bring out a good future?
That's a really interesting question, Anuj, because we remember what happened to Inox Wind, right? That's the point. When policy suddenly changes and tariff prices start falling, and businesses and, the entire setup starts getting under question.
See, the point is that, if people have had experience of Suzlon, this is a similar type of company. These companies, either they are way over leveraged, or they are dependent so much on government policy. The best companies to buy are companies which have nothing to do with government policy. I call them sabun tel companies, or things like Whirlpool, Hitachi Home, simple consumer businesses where nothing can go wrong. Cera Sanitary Ware, those sort of companies where these power tariffs, one day they go up, one day they go down, policy changes. If you stay away from such companies, you will avoid such disasters. As far as I am concerned, if I were you, it's a 20%, 25% loss, but I would take it and move on, because once something goes wrong, it tends to get worsened before it better.
My question is like, how do you see the wellness sector after 3 years down the line?
Well, I would say that, most companies, pharma companies are focused only on the US. I think for them, life is going to become tough. So, look at companies which are, pharma is a business where there is a huge value addition, great margins, the kind of business which everybody would like to get into. There are a lot of other companies which are doing business in other countries, say Southeast Asia or Europe. So, the margins are going to be good, and there may come a time where because of the negatives which are going around in the pharma sector, some of these companies may start looking at maybe trading at very juicy valuation. So you should be on the lookout for those kind of companies. And as far as the hospital and other stocks are concerned, I think these are driven by India's consumption story, and I think they will continue to do well.
Well, plenty of insights over there. Thank you, Delhi, so much for this interaction. That's it for this Investor Camp. We'll see you again in another city very soon.
Focus, ideate, innovate, enable.